Welcome to the second in our series of Horizon Bites. It's my great pleasure to have Rachel Ziemba here with us today. Rachel is the founder of Ziemba Insights and also the senior advisor to Horizon Engage. And she's also Adjunct Senior Fellow at the Center for New American Security. Rachel, thank you so much for joining me today.
Thank you for having me.
One of the things, you are a very noted expert in terms of the energy sector and sanctions. So one of the things I wanted to get into a little bit today is this point about what's happening in the global energy markets, in particular the oil sector in terms of global demand. We've had reports out from the IEA, and we've also had OPEC Plus's response to that. So what exactly is happening, and is it anything to be concerned about?
What we saw out in the report from the IEA and OPEC Plus, in some ways, is more of the same of their competition, right? And their sort of battles going on. The IEA very much focused on the energy transition in the long term. OPEC Plus really sort of having a view, perhaps self-serving, but they have a view that oil demand is far from peaking, and that even when it peaks, that oil demand will remain high. Now, their view is also one of economic development. Their concern is that oil prices need to be strong enough to support investment, that emerging economies, developing economies need to be able to power their economies, that renewable energy, as much as it can be, sort of additive, is not going to solve, all of the needs. And so I think you do really have this debate going on, and they remain very far apart, not just in their views about 2030, but even about their views for 2024. There's more than 1 million barrel a day difference between these two entities, these two groups. So that, I think, well, it adds to volatility. It might create some interesting trading opportunities, but I think it only adds to the fact that there's more opacity about data, how much, especially some OPEC Plus countries, are actually producing, what will the production really be. And so, but in terms of concern, we had OPEC Plus come out and commit to a gradual phase out of some of their cuts, right? They have 3 levels of cuts. The challenge is what OPEC Plus is trying to do. They're trying to manage the markets, keep prices high, or manageable for them. And what you end up with is that, if anything, they've been high enough that other players, non-OPEC Plus countries, have continued to add to the market. So
particularly
the United States, but also Brazil, Guyana is entering the market, and with prices in the sort of moderate to high side, people make choices about how much to consume. And the big change, I think, that has occurred is that Chinese demand is growing more slowly. There's still sources of demand growth for oil, India for one, Southeast Asia, but these are price competitive areas. But with China, the electrification story is well underway. They buy a lot of electric vehicles. Those electric vehicles are, some of them still powered by coal, right? But you're having a dynamic where both consumer and industrial demand for oil products has been growing more slowly. And so I think that's going to be part of the story going forward. And then you have the United States, which is still doing quite well economically, and we've seen that in the sort of Fed, holding on, not ready to cut rates. The labor market is doing okay. Core inflation is a bit sticky. This is really a story, I think, about industrial policy, but you're having a dynamic where U.S. oil demand, energy demand is holding up, but it's not growing very strongly. So I think you have a dynamic where listed oil companies, they're doing pretty well. They're returning money to their shareholders. That's another reason why the equities are doing well. But on a medium-term perspective, I think there are a lot of challenges ahead.
Getting to that medium-term perspective, we've seen the various promises coming out of the U.S. from the Inflation Reduction Act, the subsidies going to green energy development. We've had that in the EU, of course. But how is that changing that you see following on from the EU parliamentary elections, as well as the US election, where we may see a potential rollback of some of these programs to fund the renewable sector?
Sure. So let's take Europe first. So I think the couple takeaways from the European elections, right? The biggest one when you look at the results is this move away from the Greens, right? And so the natural response is, okay, well, people don't want to vote for the Greens. They don't care about energy transition. And of course the other big story was the rise of the far right, but also this sort of move away from the left broadly defined. And I mention that because actually the center-right bloc in the European Parliament, if anything, is as large or larger. So there is sort of ability to get things done. So maybe, not to say that the rise of the far-right parties doesn't have its own concerns and distortions. It does. But this is probably one in which the new commission will be able to get appointed. But so on this question of green, some of the reaction of people don't like the Greens and therefore no, green energy policies are out, sort of de-emphasizes the fact that actually a lot of it was center-right and center-left governments that brought in energy transition policies. So just because people aren't voting for the Greens doesn't mean that we won't have renewable energy policies. But it does highlight, in my view, this greater concern for economic security more broadly, the protection of the European industrial base, and probably divides between some of the EU members. Now, the big thing people are looking at right now is what's going to happen in France, right? And this is we're going to know really quite quickly. Macron called snap elections. His list did particularly badly. He was hoping to catch the Front National off guard. It does seem like the French political sort of spectrum is reconsolidating in a way that this is a risky
Very
gambit.
risky.
So we'll see exactly where that plays out for the French legislature. But overall, I think we're also seeing a Europe that has had several years of both energy price volatility and higher costs for things like food and fertilizer and fuel. Some of that very high cost has come off now as markets have adjusted to sort of the conflict in Ukraine and as the types of sanctions imposed on Russia have led to workarounds.
But when we get to those workarounds, a lot of that now we're seeing, okay, if they're not getting it from Russia, they're getting it more from the Middle East perhaps, but we've had the problems with the Houthi attacks. We've had trade routes altered. We've had freight charges going up quite considerably now. They're starting to go back up. So, the implications of that for Europe in alignment with these potential policies, is it still there?
The issue, I think, is that the combination of commitment to energy transition and also commitment to protecting domestic industry is via tariffs, via other incentives, is going to lead to prices going up for a lot of developed economy consumers. And we saw some weeks ago new tariffs on China from the US. We saw details on EV tariffs out of Europe, really trying to protect domestic industry, even if some of the domestic industry players don't like these tariffs. So I think this is an environment that probably both increases some of the costs to the end consumer, and it creates more price volatility. So that's sort of Europe and the global story. The U.S. with this election, this commitment to the energy transition is more of an open question. In a sense, the U.S. commitment to the energy transition is pretty recent. Texas has been one of the largest rollouts of wind and solar power. So it's not only California, it's not only New York and the Democratic states. Many of the renewable energy projects have actually been in southern states. And arguably, when you look at Biden administration industrial policy on semiconductors wars and on the IRA, a larger portion of those projects have happened in Republican states. Now, some of that is just that companies are good at finding ways to make money. They might prefer to go to states that are less unionized. That's not the only story. And some of the dynamics, and especially the Texas wind and solar story, is one of, Texas has its own grid, right? They don't want to be connected to the rest of the nation. And they've had a lot of power outages. And so this incentive to build more. And they also have the flat land and terrain and needs. So, but one of the question marks going forward, so even if these regions are benefiting, what's going to be the federal push in this way? And so my view is that it's not going to be the whole IRA that's dismantled, but things like the grants from the DOE for innovation, research and development, those are probably going to go, unfortunately, because that means underinvestment. We don't know what the new technologies are going to be.
Particularly in an era where we're not looking at interest rates coming down anytime soon, so the cost of capital
is quite
high.
Exactly. And that's been one of the challenges with some of the projects like an offshore wind. When we think globally about the energy transition, is that first in the US and then in Europe, what we're seeing is the energy transition goals are now coupled with political and job creation goals. And that can create more economic growth, but it also creates more distortions and will raise the cost of some of the inputs. And we're now seeing even countries like Brazil impose tariffs on Chinese electric vehicles. So I think this is an environment of governments using their balance sheet in creative ways, investing in these sectors, but also leading to more volatility and compliance costs for companies, which may be difficult to pass on to consumers.
We've been seeing in terms of equity markets, really great performance out of the US. It's reached yet another high yesterday. It's been up this year pretty much, mostly on the tech side of things. What are the implications then for investors? Both within US markets and in European equity markets?
You're right. This is another year of not only sort of strong U.S. equity returns, but quite concentrated U.S. equity returns. It's somewhat different tech players. This year, we really have the chip manufacturers and the like, and it's not only NVIDIA, though that's been a big part of the story, but across the tech space, Apple and the like. I think in the near term, the U.S. continuing to pull in capital because of this industrial policy story. From an equity perspective, one of the challenges is this interest rates remaining high story. There might be sort of value in some emerging market equity sectors, particularly Southeast Asia. There might even be some opportunities later in the fall in places like Mexico, if we go back to a nearshoring story.
And we are looking at obviously post-Mexican election, the peso has devalued quite significantly, but there's still that idea that it will benefit from that nearshoring.
Yes, and some of it, the benefit of nearshoring has been almost despite the government rather than because of it. 2026, the USMCA comes up for renewal or discussion, and I think we're going to see a lot of trade threats. The Trump administration has been very clear that they see the Biden tariffs and want to raise them. They don't want to just do tariffs to protect clean energy supply chains.
I wanted to just touch on that point of tariffs, because it's not just you touched on it earlier in terms of the EU looking to protect its industry and raising tariffs. We're looking obviously at the US raising tariffs. Is this going to become much more of an issue as we get in closer to those elections, US elections in November? The fallout from the European parliamentary election, but you also have it potentially in emerging markets that have had big elections, India, for example. So what are the implications for global trade as a result? Are we going to be looking at a global trade war happening?
I think you're going to be looking at a global trading environment that becomes increasingly segmented, that there are more restrictions. I mean, we had a relatively sizable increase in trade interventions during the pandemic, both because of borders being shut down, but also because everyone wanted to keep, a sort of medical devices for themselves and to sort of protect in that way. I think going forward, we are going to see more use of these trade remedies. The United States, when we look at the U.S., tariffs are almost one of the few bipartisan agreement areas. They don't agree on which items should be targeted and how much, but they do agree that tariffs are a good thing. Now, and of course, the Biden administration kept on almost all of the Trump administration tariffs. The big thing that they changed was that they didn't apply some of the steel and aluminum tariffs that went to U.S. allies, sort of other developed economies and close emerging markets. If you have a new Biden administration, I think we'll see more targeted tariffs, especially trying to protect the areas that the U.S. government, U.S. taxpayers are paying to increase capacity in. So it might not be across the board. In a Trump administration, you could well see quite sizable tariffs across all Chinese goods and maybe somewhat smaller ones across a range of global economies. Why would they do that? Because they don't want a circumstance that happened in the first Trump administration or the Trump administration. But in that circumstance, they imposed a lot of tariffs on Chinese products. What happened? Those same product types, suddenly the U.S. was still importing them, but they were importing them from Malaysia or Vietnam. And so look, businesses are smart. If their choice is pay a sizable tariff in one country, or change your supply chain, and you feel like that cost is permanent, you might want to invest in changing your supply chain. So there are all costs and trade-offs involved.
We have seen, of course, that rise post-COVID, at least in discussions, I don't know how much in action, of that friend-shoring, near-shoring, part of that whole reshoring story. And it is very much of, that geo-fragmentation that, in fact, the IMF has often spoken about over the past year. What do we see happening as a result of everything you've discussed in terms of potential for trade wars, energy prices still remaining high, because even if we get through, we stay on that transition pathway, we're still going to see energy prices remaining high. We're still in a high interest rate environment. We will be for a considerable period of time moving forward, because the Fed, maybe one cut this year is what they're now projecting, down from, markets in January were saying 6, now it's 1, and they're still hoping for 2, but really shouldn't bet against the Fed. The Bank of England moving very slowly as well. The UK is in a very unique position, having kind of the worst of both worlds. And Europe did its first cut and may be sitting back and regretting this. The ECB cutting, of course, we've had cuts by the Swiss National Bank as well, and the Swedish Riksbank. China is holding on, saying we're not going to be raising, if anything, we'll be cutting. We're worried about what's going on with our economy. And Japan, as of this morning, is still kind of sitting on the fence. So what do you see happening to the global economy, given that the inputs are still going to remain quite high? The cost of capital, we're looking at tariff barriers remaining, and we're looking at energy costs still remaining high. We'll get those levels of growth.
Yeah, so I think we won't get the historic levels of growth. I mean, either the ones that came right after the exit from lockdown, right, which were really sort of an exit effect, and were really a function of, if anything, the sort of very extensive fiscal stimulus that was probably necessary during the pandemic did not need to be continued quite as long as it was in some economies, or at least that shift over to infrastructure spending and the like maybe happened a little bit more slowly. So I think we are looking at this period of sort of sluggish growth and maybe a new normal. I do think it's one in which, from a developed market perspective, the U.S. does look like the strongest, sort of space. part of that, there is this question of, could we be facing a fiscal cliff going into, if not 2025, but into 2026? That might depend on not only who the president is, but the composition of Congress, right? Absolutely. Budgets have to be passed by Congress. We saw a lot of trouble passing not just things like Ukrainian aid, but even sort of domestic budgets, and that could continue, particularly since one of the potential configurations would be a Republican presidency and Democratic Congress. I think the net result is probably going to avoid a big fiscal cliff, just because at the end of the day, these politicians want to be elected again. So any case, but at the global level, I think you do end up with a circumstance where sort of the Fed, if anything, is still sort of, in a sense, out in front or maybe lagging behind, but with some of the highest interest rates, I think that has implications. Of course, there can weigh on growth, but I think it also has implications of the dollar still remaining relatively strong versus its peers. Some emerging market economies and currencies probably doing well. Some of those who themselves had hiked rates and are benefiting from carry trades. I think you'll probably see more yen and maybe euro-funded carry trades in the sort of next period of time, may be constrained by the sort of electoral cycle. People don't want to be sort of caught out with any flight to safety story. But overall, I think you're looking at a dynamic. You mentioned China and no room to be sort of tightening or the like. What I think China is doing right now is really trying to put a floor under the property market weakness, avoid further downdrafts. But what they're doing is sort of holding back supply, keeping prices from falling too far, keeping it from sort of a clearing rate. And I think that means that it gets spread out more over time and continues to be a drag on growth. Now that in turn increases China's incentive to boost exports. So you have a dynamic where China's additional capacity is having a deflationary and somewhat disinflationary role on the world. But at the same time, then you layer on the tariffs.
Exactly.
And so I think you end up with this sort of question of who's collecting these sort of rents. And I do think some of these export-oriented both economies, but also companies, even some of the Chinese ones, will probably do fairly well. I've seen some analysis of the, admittedly more targeted, sort of European tariffs that suggest that Chinese companies like BYD, sure, they're going to have to, their cars are going to be available in these markets at a higher cost, but they're still going to have quite a sizable sort of profit margin. Moving
on to that point on the commodity side, that point in terms of in the green transition, the demand for related commodities, what do you see happening there with those commodities, and what does that mean for investors?
Sure. So what we've actually been seeing is a drop in the price of key battery minerals, lithium in particular, but also some others. That reflects the fact that, if anything, electric vehicle demand is up from several years ago, but it's not as strong as expectations were. Also, China continues to add processing and other capacity and the like on lithium and some of these battery minerals. They're actually quite lightly financialized, right? You can trade these metals, but there's not a lot of physical trading outside of China. And so we've really had prices drop, and that in turn has led to longer term investments being put on hold, notably in Australia, for example. Some of that's just a labor cost and interest rate, related, putting on hold. But I think it leads to this fundamental disconnect between current fundamentals and longer term fundamentals. And I don't think that'll be resolved until after this electoral cycle plays out. What I'd be watching for is new market tools and regulation that might actually mean some government money put towards deepening these capital markets, which could make them more tradable, more hedgeable, and provide some opportunities. Now, with the more traded commodities, those like copper or even nickel, what we used to call base metals, but now are critical minerals, part of the electrification metals, those, I think, very much going to be driven by sort of Chinese demand and the like. They were under pressure, but we've really seen sort of supply side, cutbacks in that way. The recent run-up might be a bit overdone, but I think that these will sort of, structurally, we have such a need for copper to build out grids, to build out anything in the electricity economy. And of course, we're seeing data centers and AI be a real driver of power demand growth. Absolutely. Now, high power costs, people find ways to use less power, to be more efficient. We see that even with sort of battery technology, but I still think it provides sort of, a baseline of demand for some of these metals.
Great. My final question is really on the biggest risks and opportunities you see for the rest of this year for investors.
Biggest risk, some of the rhetoric, particularly out of the U.S. on the, on the election front, I think as one starts to think about broad cross-the-board tariffs. Now, some of these are maybe more heading into 2025 risks. Also, risks relating to, OPEC's ability to manage the oil markets, where we started out. Will there actually be enough demand that they can start adding supply back into the market? I'm not sure. Those kind of dynamics maybe provide some opportunity for those who might want to short these markets. But ultimately, I think the real question is going to be how some of the countries, including some of the emerging markets that have just gone through sort of tight elections, how they send the message about what their economic policy mix is going to be going forward to their populations, which in some ways are almost even more important than the markets. I'm watching India, I'm watching places like South Africa, and of course really watching will Europe be as coherent a policy-making, vehicle as it's been in the last, few years, obviously under threat from, a war on its borders, but we've really seen the European Commission, the European Union come together, act together, be much more muscular and geoeconomic. I'm not sure that that's going to be the case in the next 5 years. Maybe, we'll see if we go back to member state bickering or divides domestically, but those would be some of the things I'd be watching, and how that then ties into the regulatory risks.
Rachel, thank you so much for such a wonderful conversation. It was incredibly informative. I'm sure our audience will gain so much in terms of learning about what's happening with global energy markets, what's happening with the US election, the results of the European parliamentary elections, the impact on emerging markets in terms of trade, regulatory policy change, transition. It's wonderful. Thank you so much.
Thank you for having me, and I look forward to future conversations.
Thank you for watching this edition of Horizon Bites with our guest, Rachel Ziemba. Please stay tuned for future episodes.